So let's get started talking about the economics calendar. The economics calendar is an analysis tool for traders to position themselves to take advantage of future currency movement. The economics calendar, which is published daily, is the main trading tool for traders that use fundamental analysis as signals for entering or exiting trades. Economic and political news can change the direction of an asset in seconds. And fundamentals that were true in one instance of time can be rendered absolutely meaningless by fresh fundamentals. On top of it, even if you're a technical trader, all the technical information you have can give you a perfectly developed trade. You've got everything exactly right, except you don't realize that there's a major economic event that might cause a little bit of volatility, even if it only causes that volatility for a few minutes, and the asset goes right back to where it was trading. The fact is, you didn't put your stop loss far enough away to account for that momentary volatility. So it's important that you know about all the economic events. And these come to you through the economics calendar, which is programmed months in advance. Traders will know that a meeting of the European Central Bank to discuss policy and when it'll take place and when they're going to release the information, when they're going to make speeches. And this gives traders time to do some research and analysis and position themselves accordingly. Most, if not all, brokers publish a live economics calendar, which updates almost immediately when the data is released. Now, on your screen, you see tomorrow's economics calendar. Now, I've cleaned it up and taken all the low-level events out, and we can see that there's a lot of events that are going to shake up the markets. We have the European Leaders Summit. We have the European Council meeting. We have foreign direct investment out of China. We have industrial production out of Japan. Then we have a speech from one of the ECB members. Then we have a major event, which is U.S. retail sales. And then we have a speech by the Federal Reserve, Williams, who's a president of one of the branches of the Feds. And then we have another speech by an ECB member. All of these might not shake up the markets. They might not change anything, but they could spark momentary volatility where things like U.S. retail sales, which are rated a top level, can change the markets drastically. Now, when an economic release comes out, markets can react violently as traders enter and exit positions based on new information. Some news releases are more important than others, like the non-farm payroll report, the jobs report out of the UK, the Bank of England meeting, the ECB meeting, the Federal Reserve interest rate decisions, major inflation reports. All can have a big move on the markets. Now, I'm going to share with you a little presentation on fundamental analysis. And then we're going to go back and talk about the events that can actually cause volatility in the marketplace.
Fundamental analysis involves studying the economics of a country and determining the effect this has on the value of its currency. There are economic indicators that traders can observe in order to determine the strength of an economy. They are released as reports at certain times, and they can be released weekly, monthly, or quarterly, depending on the report. If an economy is determined to be strong, foreign investors will seek investment opportunities in that country, because a strong economy is more likely to present opportunities, such as returns on real estate or the stock market. In order to invest capital into a country, an investor will first need to convert their capital into that country's currency. If it is therefore perceived that the economy will produce great returns for investment, then that country's currency will be more in demand, and hence the currency value will appreciate. So, if US investors wish to invest in the UK because the UK is showing a strong indication of a growing economy, the demand for the pound will increase, and so the value increases. If the economy is seen to be weak, then investors are likely to seek investment opportunities elsewhere in a stronger economy, withdraw capital, and convert it to the stronger economy's currency. The currency of the weak economy will depreciate in value because of the lower demand for it. So when economic reports are released, investors and traders will look for signs that an economy is either strong or not. Before these reports are released, there is a certain amount of speculation as to what they may be, and traders will buy or sell currencies in anticipation of these results. For example, if the majority of traders think the results of an economic report will be negative, they tend to sell the currency ahead of the release, causing the price to fall. When this happens, we refer to the markets as being priced in, meaning that by the time the event has taken place, the price has already changed as expected. If the actual results are very different to what was expected, then this tends to have a big impact on the price of the currency. Price action can become very volatile, as traders price in the new and unexpected results. After a news release, the markets can still be volatile, even if the results are as they were expected, as traders need time to find out what the most probable impact of the reported figure will be. Therefore, as a beginner, it is generally best you stay out of any trades before and just after the release. Once you have more experience, you can learn about news trading and specialized strategies for it. So far, you have learned that.
So the question is it foolish to ignore the news? Well, in fact, some of my best trading wins have come from reacting quickly to big economic releases such as the U.S. non-farm payroll report or the Fed rate hikes. And I have previously spoken of the importance of buying the rumor and selling the fact. In effect, anticipating the news release before it comes out. In my view, news events can offer low-risk trade setup so long as you're aware of three things: the market expectations running up to the event, the likely reaction from different outcomes, and the best way to play those outcomes. Now, economic data tends to be one of the most important catalysts for short-term movement in any market, but this is particularly true in the currency market and the U.S. stock market, which responds not only to U.S. economic news, but also to news from around the world. With at least 8 major currencies available for trading at most currency brokers and more than 17 derivatives of them, there is also some piece of economic data slated for release that traders can use to inform the positions they take. Generally, no less than 7 pieces of data released daily, and from the 8 major currencies or countries that are closely followed. Now, trading the news is harder than it sounds. Not only is the report consensus figure important, but so are the whisper numbers and the revisions. Also, some releases are more important than others. This can be measured in terms of both significance of the country releasing the data and the importance of the release in relation to other pieces of data being released at the same time. Now, first off, markets move a lot more in line with what the expectations are for an upcoming economic release rather than with what the actual news release implies. Meaning, because traders trade their beliefs about upcoming news events, often when the news event or the actual event or the news release happens, the move is either over or ready to become roaring back in the opposite direction. Now, if you are a long-term investor, you are concerned with what the economic event says about the country in long term. If you're a short-term trader like an ETX trader, you're only looking for opportunities for short-term results. You don't care whether the non-farm payroll report was good or bad. You only care what it was in relation to the consensus, what the instant volatility will be. Not that it will eventually make the dollar stronger because it means the economy is good. It's, will it sink the dollar today, or has the dollar been traded in already? Or will gold go up in reaction to this? Okay. Or will the S&P jump because it's like we had that exceptionally good jobs report last week? Okay, it sent the S&P up, it sent the US dollar up, but 2 days later everything was back to normal. So it really didn't help a long-term investor. A long-term investor isn't concerned with a single news release. They're looking at quarters, annuals, 6 months. And so it's different how things last. But when a major report comes out and misses or exceeds expectation, there's an instant knee-jerk response. The markets will then correct and then will adjust to its new level. So if you think of this as the kids in their report cards, because an economic event is a report card of the country's economy. Now, if you're expecting all A's from the kid and he brings you home all C's, you have an extremely negative reaction. If you're expecting all C's and D's and he brings you home all A's, you have an extremely positive reaction because it's all based on
Indicators measure how strong an economy is. It is important to understand how strong an economy is because the strength of an economy has an impact on the value of the currency. These indicators are released as reports, and the publishing times are released ahead of the actual publication. Interest rates are one of the most important drivers of the currency markets. They are normally set by a country's central bank. For the United States, interest rates are set by the Federal Reserve Bank, and for the Eurozone, the European Central Bank is responsible for setting the interest rates. The central banks use the interest rates to promote economic growth or to curb inflation. Let's take a look at the mechanisms behind this. The central bank of a country lends money to commercial banks, and the interest rates set by the central bank are what the commercial banks have to pay for borrowing the money. This is referred to as the base interest rate. These commercial banks also lend money to people that want to buy things, such as a house. The minimum interest they have to pay is the minimum based on the interest the central bank has set. So, if the central bank changes the interest rate a commercial bank charges also changes. Now let's have a closer look at how the interest rates specifically affect a country's currency. When the central bank increases the interest rates, the cost of borrowing goes up. This means that homeowners now have to pay more on their mortgages and, as an effect, have less money to spend on commercial goods. Therefore, the demand for these goods, like cars, will go down. Manufacturers are now faced with a lower demand for their goods and are not able to raise the price that much. Therefore, raising interest rates will curb the economy by decreasing the demand for goods and services and will reduce inflation. However, when the economy is not doing so well, the central bank might want to decrease the interest rates to stimulate the economy. Now, when the interest rates are lower, a homeowner spends less on his mortgage and therefore has more money to buy other goods and services like cars. These goods need to be produced, so by lowering interest rates, production will rise and thereby stimulate economic growth. Of course, it is not just mortgages that are affected by interest rates. Factories and other areas of industry borrow money to invest in growth. When interest rates are low, the cost of borrowing is low. Business owners will be more inclined to grow their business and will therefore borrow money. This money is invested in the economy, spurting further growth. On the other hand, when interest rates rise, business owners will not continue to invest as much because it is more expensive for them to do so. The economy will slow down as a result of less money invested. A higher interest rate means that you gain higher rates of return for the money you hold in your savings account. This is also why higher interest rates benefit those who have savings. If one country has a higher interest rate than another country, money will flow into the country with the higher interest rate because investors will get more interest on their money. Because the country with the low interest rate currency has to be exchanged for the country with the higher interest rate currency, this increases the demand for the higher interest rate currency, and the currency appreciates in value. Inflation measures the rate at which prices of goods and services rise in a given period. If inflation is too high, prices increase significantly and therefore reduce the purchasing power of money. In other words, the disposable income that consumers have is reduced. This can have a negative effect on the economy and hence the currency. However, if a country experiences low inflation, prices become stagnant or rise too slowly. Investors could see this as an indication that the economy is not as strong. Therefore, this could also have a negative effect on the value of a currency. To protect consumers from excessive inflation, central banks will tend to raise interest rates. This is because it reduces the spending power that consumers have, and so there is reduced demand for goods and services. Under reduced demand, the price for goods and services are kept to an optimal rate. When inflationary data is higher than expected, traders may buy the currency of a country in anticipation of an interest rate hike from the central bank. However, it depends on the economic conditions because excessive inflation could erode the value of any capital within that economy, which means that the value of the currency could decline. The terms hawkish and dovish refer to how a central bank will manage the balance between inflation and growth. If a central bank is concerned about inflation, it is considered hawkish and is more likely to adopt a higher interest rate. If a central bank is concerned about growth, it is considered dovish and is more likely to adopt a lower interest rate. So
all of that's important to know, and how each one of these economic events goes together to form a cycle, and how the jobs report is important to how the central bank acts, because the U.S. Fed's mandate is low inflation and full employment. So when we're having very, very good job reports, that means the Federal Reserve has done their job and they're not about to move rates because they don't have to react to anything. But they're not looking to react today because their changes take a long time. They're looking at keeping inflation steady a year from now and keeping jobs market fully function a year from now. So they're not as concerned with the individual reports. They're more concerned with quarterlies and semi-annuals and annuals. Now, there's other factors you have to take into account if you're going to trade the news. You have to understand how everything relates together, but it's not as simple as it seems. For instance, right now globally, crude oil for the last 2 years has been at the very low end of its range. That means gasoline prices, especially in the US, are very, very low. That means a consumer who was used to spending $1 more a gallon just a couple years ago has more money, expendable cash in their pocket. So they're spending more money in retail sales, and they're not as concerned with a small interest rate increase because it makes a couple dollars difference in their credit card bill, but they're saving $100 or $200 a month in fuel costs. Also, when fuel is down, when gasoline prices are down, that means truckers have to charge less for transportation of goods. Manufacturers' petroleum use is down because their cost for production is down. So they're not creating inflation and they're not having to raise prices because their costs are down. So you have to be able to put the whole story together. But trading the news can be very profitable if you can correctly guess which way price is going to move. Price can often move 30 or 40 pips very quickly on big news releases. But remember, it also increases volatility. And also, you have to have a huge risk management construction to take care of this. So most traders do not trade the news as it's just too risky. And you often get stopped out as prices move one way and then the other. Most traders have experienced this whipsaw effect when prices go up and then down very, very quickly, and then down, then up. So it seems no matter which way you trade, you're always seem to get stopped out. So what I found most effective is I trade before the economics release. If I see the markets being pushed down or a currency being pushed down because of market expectations, I'll sell that asset and be out of it, take my profit and be out of it before that news release is due to come out. Because I just see a small short term as traders are starting to take position a few hours before I'll go in and take a couple pips as it keeps pushing down. I don't need to get rich. I don't need 30 or 40 pips. I'll be happy with 10 or 12. Okay? And I get out of the market before the event. So there are different strategies that you can employ, but you have to understand them and understand exactly what's going to happen. You have to protect yourself and cover your risk. But it's a very good way to trade, and making sure you know all the economic events on the calendar, no matter what you're trading, is always important, because you have to be prepared for that momentary volatility. So if you had a perfect trade on Facebook, okay, or a perfect trade, and let's get out of stock, you had a perfect trade on a gold miner. Let's go out of that. You had a perfect trade for the euro US dollar. Okay. And if the euro US dollar trading at 104.92 in the morning, you were sure it's going to go up to 105.50 by the afternoon. And it did. At 1 o'clock in the afternoon, it was right where you said it was going to be, 105.50. You entered at 104.92. Okay. You could have made a ton of money, except you didn't realize a half hour before there was a major economic event. And even though that event didn't really do anything to the markets, for that few minutes, it created that volatility that stopped you out. So you were stopped out of that profitable trade before it ever got in your favor. So keep in mind, you should always be looking at the economics calendar just to see what's going on, regardless whether you're going to trade from it or not. You should be aware of what could spark a problem with any trade that you're making. So thank you very much for joining us. Thanks for being part of ETX. I wish you all a very happy and healthy New Year. And as we move into the holiday season, we'll see less and less of you until the new year, but we're still here for the next few weeks. Bye now.